Hi, welcome everyone to another financial analysis video with myself, Moeed Amin, and my colleague, Ted Wayman. Before we get into the company that we're going to be analyzing today, don't forget to like, share, subscribe, especially if you are one of our many viewers who has made a request for a specific company for us to analyze. If you are a subscriber, you will receive instant notification of when we publish those videos. So do make sure that you do so. Today, Ted and I are going to talk about Kainos Group. Now, Kainos Group they're a company that's headquartered in Northern Ireland, and they are floated on the AIM exchange, so the alternative investment market in the UK. Essentially, they're a software company, and they describe themselves as a company that helps businesses and government organizations build their digital capabilities and also help them in their digital transformation. So think about things like cloud infrastructure, data and AI, even automation. And they specifically focus with companies in the healthcare and sciences sector, the financial services, education, and government. So before we get into the finances here and a brief intro into the stock price, let's thank one of our viewers who made this request. So here is your video, and we would love to hear your comments and thoughts, and if you have any more information to add to this analysis. So before we go into the financial analysis, just a note on the stock price, and this is a great one because they floated in 2015. Now, if you had invested in 2015, this is an 11-bagger business. So just to explain that, you get 5 baggers, 10 baggers. These are companies where they 5x or 10x your investment. So this company, since 2015, if you invested then, you would have made 11 times your investment. So great story to see here. And we're really looking forward to sharing the finances behind that. But remember, these videos are not forward-looking. Ted has explained this in a previous video that we've done. These are not forward-looking information. This is to help you get really proficient at analyzing the financial fundamentals of a company, which is important as part of your investment thesis because you do want to be able to look at the retrospective as well as the forward-looking information. So Ted, let's share with our viewers what we have found about this company. Maybe the financiers will talk a little bit about the health of the business and maybe a hint as to why they grew so big as well.
Well, good to see you, Moeed. Yes, thank you very much. So you're absolutely right. This is the financial analysis. We got a comment a while ago from somebody who said it was a bit backward looking. Well, welcome to financial analysis. We're looking at the numbers, and this is backward looking. This is looking at the report for the year ended 2021, but it's only for the year ended the beginning of 2021. So and if you do want to have a look through this report, strongly recommend it if you're an investor, potential investor, or just want to know more about what they do in detail. Do have a look at this report. It's on their website. It's very easy to access. Just type in annual report. And don't forget that when you're reading it, this will have a sort of element of spin in it. So they will definitely be putting their best foot forward. And what we're going to do is we're going to leave you viewers to read through this yourself. You don't need me to read it for you. What we're going to do is go down and look at the numbers because some people struggle with actually interpreting the numbers. So here we go. Here is the income statement. So what do we see? So first of all, top line, looking at the sales, you'll notice that this is in thousands of pounds. So top line sales, £235 million, a 31% increase on the previous year. Now, I haven't looked back at all the previous years back to when they floated and before that, but this company is still growing. So if it has been growing in the past, it's still got stellar growth, 31% increase in revenue. So big tick there. Cost of sales is about 50%, leaving them with a 50% gross margin. So for every pound they sell, it costs them 50p to provide the service, and therefore they get to keep the other 50p. Fantastic. So that is another big tick, a nice big juicy margin there. The operating expenses, that's the cost of running the business, sometimes referred to as SG&A, the sales, general and administrative costs. So that'll be marketing, HR, finance, rent, rate, light, heat, travel, all that kind of stuff. 68 million, a little bit up from 59 million, but still very, very profitable. Really nice, healthy profit margin, 21%. Interest payable, very small, no interest, no debt. So I'm expecting to see very low levels of debt, possibly a reasonable amount of cash sitting on the balance sheet. If they've got nice financial income, that means they're going to have cash. And if they've got a low expense, it means they're going to have low amounts of debt. They're paying tax because they're profitable. Bottom line, they're making a nice big juicy profit of 40 million pounds. Okay, up from 18.5 million pounds in the previous year. So this company is growing, it's profitable, it's ticking a lot of boxes. I kind of like this company at the moment. Maybe there's a few gremlins under the bonnet a little bit later on, but right now that's a really healthy looking income statement. So let's jump on and look at the balance sheet and see what we can see in the balance sheet. So here are the total assets. The total assets, we notice, first of all, we've got the non-current assets. These are the things we need to run the business. Biggest number there by far, property, plant and equipment. Okay, so that's good. So that's going to be all that kind of, you know, the stuff, you know, tables and chairs and all that kind of stuff. It's not just tables and chairs. There's a lot of other stuff in there as well. The big number, though, is their current assets, 139 million pounds. And within that, the biggest number easily is the cash and cash equivalents. And in fact, not only is it cash and cash equivalents, but they've also got these treasury deposits. Treasury deposits, it's going to be another form of cash. It's just parking cash. So they've got whatever that is, about $80 million, pounds, 80 million pounds of cash just sitting there. They've got a little bit of accrued income. Which is a kind of basically, you know, income due to them. So we can read this accrued income in the same breath as trade receivables. The way to think about accrued income is like sales which I've made, but I just haven't invoiced yet. And then the trade and other receivables are people who I have sent an invoice to. So we can probably, you know, draw, you know, those two together. There's no inventory, obviously, because of the nature of their business. So these guys have got 36, 46, 50, but, you know, 50, 56, sort of 54, 55 million dollars owed to them. And they've got a cash pile of another $80 million. So that's a pretty strong balance sheet, certainly on the asset side. Let's look at the liabilities. So we'll scroll down a little bit, look at the liabilities section. Current liabilities, 72 million. Really not an issue there. I mean, it's less than their cash pile, so they could pay off their current liabilities just like that. So liquidity, not a problem at all. And in terms of the non-current liabilities, very small numbers indeed. No debt, no interest, as we discussed. So these guys, you know, really very, very strong balance sheet. Their net assets, 88 million pounds, and that net assets is represented by the shareholders funds. Here are the shareholders funds down the bottom. Share capital and share premium, that's basically what the shareholders have physically invested into this business. So this is what they've actually, you know, stuck in. And then also we can see by far the biggest number is the retained earnings. These guys have been making a profit hand over fist. They've been making a profit year on year on year, and a lot of that profit has been reinvested back into the business. So this is looking fantastic. I mean, you know, really, really strong balance sheet, absolutely flying income statement. Well, let's move on. Look at the movement in equity. Movement in equity, quite nice here. So we can see here's the profit figures. There's the profit for last year, and a little bit further down we've got the profit for this year. And then you'll also notice they're paying out dividends. They paid out 12 million in dividends last year, and I'll just clear that annotation and scroll down, and we can see the 16 million that they pay out in terms of dividends for this year. So this company We look at lots of company Moeed that don't quite have enough cash or is issuing shares and it's all jam tomorrow, jam tomorrow. This is jam yesterday and today and tomorrow. I mean, these guys are, they're very, very profitable. They've got a very strong balance sheet. They're stuffed full of cash. They're paying out dividends. This is looking, really, really, really healthy indeed. And that's maybe a reason why the share price has been performing so well. Here is their cash flow. Very important. Looking at the cash flow, and what we notice is the cash from operating activities, very cash generative. So these guys are generating lots and lots of cash, and that number actually, just so that we know, down the bottom of the cash flow statement, they actually do the sort of reconciliation down here. So they take the profit for the year, they make lots of adjustments to that profit figure, and they turn it into the cash equivalent effectively. And the way to think about this bottom number here is this is the cash equivalent of the operating profit. And often you find a big difference between that is depreciation, but the depreciation is pretty low for these guys because they haven't got any assets. So yeah, this is all looking pretty good. So 60 million pounds of cash generated during the year. What are they doing with that cash? Well, they're doing some investing. And again, we've seen this before. We'll see it again. It looks like they're doing big amounts of investing, $20 million. Dig a little bit deeper though. And what are they doing? 18 million is just being parked in cash. So because of IFRS, they have to call it investing activities, but it isn't investing activities. In the same way, if you take money out of your current account, put it in your savings account, you're not investing, you're just parking cash in a different place. So this line here, this is our investment. Not a lot of investing going on because they don't need a lot of property, plant and equipment. They're not capital intensive. And then down the bottom, here's the financing activities, dividends paid, lovely, juicy dividends. They're not raising money through debt. They're not raising money by issuing shares because they don't have to. They've got lots of cash. They're generating more cash. They're getting close to Pablo Escobar's kind of territory where it's almost, they don't know, they're making so much cash, they don't know what to do with it. So there we go. I mean, that's basically the you can see 63 million dollars of pounds of cash. Very, very, very healthy looking set of financial statements. So if we go back and look at the share price, as you mentioned, and I did enjoy your comment. Said if you'd invested, Moeed, if I started every sentence with if, I'd be a multi-billionaire by now. If you bought Bitcoin back in 2015, you'd have made even more money than investing in Kainos. But hey, that's the benefit of hindsight. What I'm much more interested in is these numbers down here, which is kind of telling me where we are now. 2.5 billion basically market cap, 2.5 billion. And that is, don't forget that the balance sheet is, only 87 million. So 2.5 billion, it's basically all goodwill. You're paying 62 times earnings, as they say there. So that's quite expensive, 62. Now, we've looked at Tesla and they were on 1,000 times earnings when we looked at them. So, it's not as expensive, but Facebook's only on 30 times earnings and it's generating lots of cash as well. So, now, what I started to look at this and I thought about it and I thought, actually, this is really where you want to be thinking about not the PE ratio, but what's known as the PEG ratio. Now, the PEG ratio is the PE divided by the G. And the G is the growth in the earnings per share. Now, the reason we use earnings per share is companies are sometimes they're issuing shares or buying back shares. So there's a little bit of distortion going on. But because these guys aren't issuing shares, they're not buying back shares, we can actually just very simply look at the growth in the net profit, which is the earnings. So the growth in the net profit has been about 113%. And if you take 62 and divide it by 113, you get 55. So if you think about this company, if the growth in the earnings, if it doubles and it's not going to double every year, let's be clear, but if it did double it, if it went up 100% every single year, this would be quite a cheap stock to buy. So it's a kind of a 0.55 PEG, and anything below 1 is looking cheap. and anything above 1 is looking expensive. That's a kind of rule of thumb, not a hard and fast rule, but it's a kind of an indicator. So when we look at this and we think 62 times earnings, that's a lot. But then if we think that actually the earnings, if they carry on going the way they're going, if these guys are continuing to, to deliver on their story, then maybe it's not as expensive as all that. And I'm going to leave my comment at that. So that's, and as I said, this is just the financial analysis. I don't know about the deals that they've just placed, the kind of, the fact that they've bought into this new territory, the expansion plans, all that kind of stuff. And I'm interested in that. So if you know about it, if you're watching this video thinking, oh, Ted, I know something you don't, stick it in the comments box. Tell us why you think that not only is 62 a bargain, but you should be filling your boots and buy now, buy now, buy now. So I'm looking at this company and, once again, I'm thinking this might be something for me to kind of, I'm not going to put my house on the line here, but certainly this looks like a company which is on its way, is continuing its stellar growth. It doesn't look like it's going to be derailed from a financial perspective. Very strong, nice cash flow. You can see it's got a dividend yield there. Looking quite nice, Moeed. Quite like this company.
Yeah, I agree. It makes a nice change from a lot of the other technology-based companies we've looked at, where they're still on that growth story. And you've really got to know a lot about that business and the industry to make that bet. So very, very, very healthy set of accounts. Love to hear everyone's comments as you just suggested there, Ted. Thank you for the video. Thank you for the analysis. And until the next video, see you later, everyone.
Good to speak to you, Moeed. Catch you later.